Entrepreneurs who achieve long-term success understand that investing is a game of logic, not emotion. While passion and enthusiasm drive innovation and business growth, investment decisions must be grounded in analysis, research, and fundamental value rather than excitement or personal beliefs. Emotional investing often leads to poor choices driven by hype, fear of missing out, or attachment to a particular brand or ideology. Smart investors focus on facts, trends, and sustainability rather than temporary waves of excitement surrounding a particular asset. The key to successful investing lies in evaluating the intrinsic value of an asset. Every great investment opportunity is backed by strong fundamentals, real-world application, and long-term viability. Bitcoin, for example, has maintained its status as a valuable cryptocurrency due to its decentralized nature, limited supply, and growing adoption as digital gold. Ethereum has thrived because of its smart contract capabilities, which have revolutionized various industries. When an entrepreneur considers investing in any cryptocurrency or financial asset, the first question should be, what problem does this solve? And does it have a sustainable future? Political and emotionally charged investments often lack the core elements that make assets valuable over time. Trump coin, for example, may carry branding appeal for supporters of Donald Trump, but an investor must ask whether this coin provides any innovation, technological advancement, or unique functionality that distinguishes it from thousands of other cryptocurrencies. If an investment is purely dependent on a name, a political movement, or an emotional response, it becomes highly vulnerable to rapid shifts in public perception. This is dangerous for any entrepreneur looking to preserve and grow wealth. Market sentiment is one of the biggest drivers of short-term price movement in speculative assets. However, sentiment is unreliable and unpredictable. Political trends shift, public figures rise and fall in popularity, and regulatory landscapes evolve. If the value of an asset is based on public enthusiasm rather than utility, it becomes a speculative gamble rather than an investment. Entrepreneurs must separate their personal beliefs from their financial strategies and make decisions that are not swayed by emotions, headlines, or social media hype. The best investors recognize that their feelings about a brand, person, or movement should never dictate financial choices. Emotional investing often leads to impulsive decisions, including buying at peaks due to excitement and selling at lows due to fear. A disciplined entrepreneur avoids this trap by focusing on data-driven decision-making. This means researching the underlying project, understanding the market dynamics, and considering long-term adoption potential. The question should always be whether an asset can sustain itself through economic cycles, regulatory scrutiny, and technological advancements. Successful entrepreneurs build wealth by investing in businesses, industries, and technologies that create value over time. They focus on innovation, problem solving, and long-term impact. Chasing speculative trends rarely leads to lasting success. If an asset lacks a clear purpose beyond its branding, it carries an extreme level of risk. Entrepreneurs who understand financial growth know that their capital should be placed in ventures with solid foundations rather than emotionally driven fads. The financial market is full of distractions, and not every opportunity is a real one. Many investors get caught up in political or ideological branding without evaluating whether the investment itself has a strong roadmap for success. Emotional investments often result in significant losses because they rely on momentum rather than sustainability. A disciplined entrepreneur takes a rational approach, analyzing risks, understanding market behavior, and focusing on opportunities that align with long-term wealth-building principles. Building financial success requires discipline, patience, and the ability to filter out hype-driven investments. Every great entrepreneur knows that while emotions have their place in motivation and vision, they should never dictate where money is placed. Separating personal opinions from financial decisions is a hallmark of strong investors who thrive in any market condition. Every successful investment is built on a foundation of fundamental value. This means that an asset must have a clear purpose, real-world utility, and long-term sustainability. Without these elements, an investment is little more than speculation relying on hype and temporary market enthusiasm rather than real economic or technological strength. Entrepreneurs understand that putting money into something without a strong foundation is risky and often leads to losses. When evaluating any opportunity, the primary question should always be, What makes this asset valuable beyond branding or popularity? And if the answer is unclear, the investment carries significant risk. A cryptocurrency's value is determined by its technology, use case, and adoption. Bitcoin, for example, has maintained its position as a leading digital asset because of its decentralized nature, scarcity, and increasing recognition as a store of value. Ethereum has secured its place in the market because of its smart contract functionality, which has created an entire ecosystem of decentralized applications. These cryptocurrencies have real-world applications, strong developer communities, and growing institutional interest. They are not simply tied to a name or a short-term trend. An investment that lacks fundamental value is vulnerable to extreme volatility and market collapse. Politically themed cryptocurrencies, such as Trump coin, often lack a core technological or financial advantage. Instead, their perceived worth is tied to political sentiment, branding, and temporary enthusiasm from a specific group of supporters. This is a dangerous basis for investment because it does not provide long-term stability or utility. If an asset's only appeal is its association with a political figure or movement, its value will fluctuate based on unpredictable external factors rather than on technological or economic merit. One of the key indicators of a strong investment is its ability to solve a problem or improve an existing system. Cryptocurrencies that succeed in the long term offer solutions for privacy, security, transaction speed, or decentralized governance. In contrast, a coin that exists primarily as a symbol rather than a tool is unlikely to maintain its value over time. Investors must ask whether an asset contributes to the growth of an industry or merely capitalizes on a trend. Without innovation, an investment is speculative at best and worthless at worst. Entrepreneurs and experienced investors prioritize assets that have a roadmap, clear objectives, and a development team actively working to enhance their product. Strong investments are backed by research, continuous improvement, and increasing adoption. If an asset lacks these elements and instead relies solely on name recognition, it is a high-risk, low-reward proposition. When the initial excitement fades, the market quickly moves on to the next trend, leaving those who invested in the hype with significant losses. Another important consideration is the scalability and adaptability of an asset. Financial markets and technological landscapes change rapidly, and only those investments with a strong foundation can survive shifts in demand, regulation, and competition. Cryptocurrencies that have survived multiple market cycles have done so because they provide real value to users, businesses, and developers. In contrast, politically themed coins often struggle to maintain relevance once the initial news cycle passes. Without a technical advantage or economic necessity, they fade into obscurity. Investing based on emotion, political allegiance, or branding alone is not a sound financial strategy. Entrepreneurs who succeed in wealth building do not gamble on trends, they invest in sustainable value. Every major investment decision should be guided by logic, research, and an understanding of long-term potential. If an asset does not offer a clear technological, financial, or practical benefit, it is nothing more than a speculative bet. Business leaders and investors who focus on value rather than hype position themselves for long-term success rather than short-lived gain. Entrepreneurs who understand risk management know that political investments come with extreme uncertainty. The financial market operates on logic, data, and long-term sustainability, while politics is driven by emotions, shifting public opinion, and unpredictable events. When an asset is tied to a political figure or movement, its value becomes dependent on external factors that investors cannot control. This makes it an inherently volatile and unreliable investment, which contradicts the principles of sound financial decision-making. An investment should be evaluated based on its ability to withstand economic cycles and regulatory changes. Political figures rise and fall in popularity, and elections, scandals, or policy shifts can dramatically alter public sentiment. If an asset's worth is primarily derived from its association with a politician, it is vulnerable to rapid devaluation the moment circumstances change. Unlike a business or technology-driven investment, politically linked assets do not have inherent utility beyond their branding. This makes them especially risky for entrepreneurs who need stability and long-term growth. Investors who have studied market trends know that assets tied to political movements often experience sharp rises and crashes based on election results or news cycles. A cryptocurrency or financial instrument that relies on political sentiment is essentially a gamble rather than an investment. Even the most well-known political figures experience shifts in public perception. If an asset's primary appeal is its connection to a leader or movement, its future is uncertain and largely out of the investor's control. Regulatory risk is another major factor that entrepreneurs must consider when evaluating political investments. Governments around the world are tightening regulations on cryptocurrencies and financial assets, especially those that appear speculative or misleading. A politically branded asset may attract unwanted scrutiny from regulators, leading to potential restrictions, fines, or even bans. Unlike widely accepted cryptocurrencies with clear utility, a politically driven asset is far more likely to face legal challenges. The uncertainty surrounding regulation makes it difficult for investors to predict whether they will be able to buy, sell, or use the asset freely in the future. Political branding can also limit an asset's market appeal. A financial instrument associated with a specific political figure automatically alienates a portion of potential investors. Unlike traditional cryptocurrencies or investments that appeal to a broad audience, a politically themed asset has a built-in limitation on its growth. If only a specific political group finds value in an asset, its demand remains restricted and its ability to attract widespread adoption is weakened. This reduces its long-term investment potential and increases the likelihood of market decline once initial enthusiasm fades. Entrepreneurs who have built successful businesses understand that sustainability is key. The best investments are those that provide long-term value, solve real-world problems, and continue to grow regardless of external political events. By contrast, a politically tied cryptocurrency is highly dependent on factors outside of an investor's control, making it a poor choice for those seeking stability and long-term financial success. The world of investing rewards those who think ahead, analyze risk carefully, and avoid emotionally driven decisions. Political cycles are temporary, and any asset that derives its value from a politician's name or ideology is inherently fragile. Savvy entrepreneurs recognize that real wealth is built by investing in innovation, technology, and businesses that provide lasting value. Chasing politically motivated investments exposes investors to unnecessary volatility and unpredictability, ultimately making them unreliable and high-risk financial choices. Market volatility is an unavoidable aspect of investing, but successful entrepreneurs understand the difference between natural market fluctuations and extreme instability driven by speculation. When an asset is closely tied to political sentiment, its value becomes subject to rapid, unpredictable swings rather than the steady growth seen in fundamentally strong investments. Political cryptocurrencies like Trump coin fall into this category, making them a dangerous bet for serious investors seeking long-term financial success. Political branding naturally introduces high volatility because public sentiment is constantly shifting. Elections, policy changes, media narratives, and scandals can drastically alter how people feel about a political figure or movement. If a cryptocurrency is directly linked to that figure, its price will fluctuate based on factors that have nothing to do with technological value, market demand, or economic fundamentals. Unlike Bitcoin, which derives its strength from decentralization and scarcity, a politically themed cryptocurrency is dependent on popularity cycles that are entirely out of an investor's control. Entrepreneurs who manage wealth wisely avoid placing capital in assets that can collapse overnight due to unpredictable events. Political assets are among the most fragile investments because their success hinges on public perception rather than utility. If a political figure associated with a cryptocurrency falls out of favor, the asset could lose most of its value in an instant. Even a single negative news cycle can trigger a massive sell-off, leaving investors with worthless tokens and no recourse to recover losses. Speculative assets tend to attract short-term traders rather than long-term investors. When a cryptocurrency is fueled by political hype, it is often subject to pump and dump cycles where early adopters drive up the price before quickly selling off their holdings. Those who enter late in the game end up losing significant amounts of money when the price collapses. Unlike a stable, well-established cryptocurrency with long-term adoption potential, politically themed assets are prone to quick booms followed by inevitable busts. Entrepreneurs understand the importance of risk mitigation, and investing in something that is entirely dependent on political cycles and media attention is not a sustainable strategy. The most successful investments are those that provide value regardless of external circumstances. Bitcoin's value, for example, is not tied to any government or political figure. It remains a store of value because of its intrinsic scarcity and decentralized nature. Political cryptocurrencies, on the other hand, have no such resilience and can crash without warning. Another major risk factor is low liquidity in politically themed cryptocurrencies. Unlike mainstream assets that have strong market demand, politically branded coins often struggle to maintain consistent trading volume. This makes it difficult for investors to sell their holdings when the market turns against them. If liquidity dries up, those holding large amounts of a political token may find themselves unable to exit their position without suffering huge losses. Regulatory uncertainty further amplifies the risks associated with politically charged cryptocurrencies. Governments and financial authorities may crack down on speculative tokens that appear to mislead investors or violate financial regulations. If regulatory agencies decide that a politically branded cryptocurrency is too risky or deceptive, they can delist it from major exchanges, making it even harder to buy or sell. For an entrepreneur, the risk of investing in a coin that could be banned or severely restricted is simply too high to justify. Savvy investors and business leaders recognize that real financial growth comes from stable, well-researched investments with real-world applications. Political hype may create short-term excitement, but it does not build sustainable wealth. Entrepreneurs who focus on assets with strong fundamentals and long-term potential avoid the pitfalls of extreme volatility and speculation, positioning themselves for lasting success rather than temporary gains. Entrepreneurs who succeed in building long-term wealth understand that not all investment opportunities are created equal. Some assets are designed to provide sustainable value, while others exist solely to capitalize on hype. Politically branded cryptocurrencies like Trump coin often fall into the latter category, making them highly susceptible to pump and dump schemes that leave unsuspecting investors with massive losses. These schemes follow a predictable pattern, and recognizing the warning signs can help entrepreneurs avoid costly mistakes. A pump and dump occurs when a small group of insiders artificially inflates the price of an asset, creating excitement and drawing in retail investors who believe they are getting in on a profitable trend. This is done through aggressive marketing, social media hype, and misleading claims about the asset's future value. Once the price reaches a peak, these insiders sell their holdings at a profit, causing the value to collapse. Those who bought in at the peak are left with a worthless investment, while the early manipulators walk away with significant gains. Politically themed cryptocurrencies are particularly vulnerable to manipulative trading strategies because they rely on branding rather than technological innovation or real-world utility. The appeal of a name or political movement can generate short-term enthusiasm, but without a strong foundation, the asset lacks the ability to sustain its value. Unlike Bitcoin, which is backed by a decentralized network and limited supply, a politically branded token derives its worth from hype and public sentiment, both of which can change rapidly. Entrepreneurs should always be cautious when an investment opportunity seems too good to be true. Pump and dump schemes often involve promises of extraordinary returns, attempts to create urgency, and vague explanations about the asset's actual function. If a cryptocurrency's primary selling point is its association with a political figure rather than a well-developed use case, this is a major red flag. Without a clear reason for its long-term adoption, it exists purely as a speculative instrument, making it an unstable choice for serious investors. One of the most damaging aspects of pump and dump cycles is their ability to erode trust in the cryptocurrency market. Investors who fall victim to these schemes often become skeptical of legitimate blockchain projects, assuming that all crypto assets operate in the same way. This damages the reputation of the industry as a whole and slows mainstream adoption. Entrepreneurs who understand market dynamics know that their investments should be directed toward projects that build trust, not ones that exploit hype for short-term gain. Another reason politically branded tokens are at high risk of being manipulated is their low liquidity and small market size. Unlike established cryptocurrencies with deep order books and widespread trading activity, many politically themed coins are thinly traded, making it easier for a small group of insiders to manipulate the price. When a pump and dump scheme is executed, the lack of liquidity makes it difficult for ordinary investors to exit their positions, trapping them in a collapsing market. Entrepreneurs who have built successful businesses understand the importance of investing in real value. They avoid assets that are driven purely by sentiment and instead focus on opportunities with strong fundamentals, innovative technology, and real-world application. By steering clear of politically driven tokens that rely on marketing gimmicks rather than actual utility, they position themselves for long-term financial stability rather than short-term speculation. Recognizing the dangers of pump and dump schemes allows investors to protect their capital and ensure that their financial decisions are based on logic, research, and sustainable growth strategies rather than hype and manipulation. Entrepreneurs who achieve lasting financial success understand the importance of investing in assets that generate real, sustainable demand. The value of any financial instrument, whether a stock, cryptocurrency, or commodity, is determined by how much people need and use it over time. If an asset lacks practical utility, its price becomes entirely speculative, making it vulnerable to extreme volatility and collapse. Politically themed cryptocurrencies, such as Trump coin, fail this fundamental test because they do not serve a unique or essential purpose in the financial ecosystem. Successful investments are driven by utility rather than branding. Bitcoin, for example, continues to maintain its dominance because it provides a decentralized store of value that cannot be easily manipulated by governments or central banks. Ethereum has gained massive adoption because its smart contract functionality enables decentralized applications, financial services, and blockchain-based innovations. These cryptocurrencies have real-world demand, ensuring that people want to buy, hold, and use them over the long term. In contrast, a politically branded coin lacks a clear problem to solve, meaning its demand is based solely on sentiment rather than function. Entrepreneurs should always ask what need an asset fulfills before investing in it. A cryptocurrency that streamlines transactions, enhances security, or improves efficiency has a reason to exist beyond speculation. Politically themed coins do not provide faster transactions, enhanced security, or any technological breakthrough. They exist purely for ideological branding, making their demand temporary and unsustainable in the long run. Once the initial excitement fades, the lack of genuine use cases ensures that most investors will move on to assets with stronger fundamentals. A key principle of long-term investing is supply and demand equilibrium. Assets that sustain value have a consistent and growing user base that creates demand, ensuring liquidity and price stability. Political cryptocurrencies often struggle with maintaining long-term demand because their audience is limited to those who align with a specific ideology. Unlike Bitcoin, which is used globally as a hedge against inflation and an alternative store of wealth, a politically branded token only appeals to a niche group, significantly restricting its growth potential. Another risk of politically branded cryptocurrencies is that they lack institutional support. Large financial institutions, hedge funds, and mainstream investors prefer assets that have clear regulations, strong technology, and a broad market appeal. Bitcoin and Ethereum have attracted institutional investment because they provide tangible benefits to financial markets and businesses. In contrast, a coin tied to a political figure does not offer the technological or financial incentives necessary to gain mainstream backing. Without institutional adoption, politically themed coins are left reliant on retail investors, who are often more prone to emotional trading and market instability. Political branding creates short-term demand based on emotions rather than financial logic. People may buy into a politically themed cryptocurrency because they support a particular figure or movement, but emotional attachment is not a reliable driver of long-term value. History has shown that assets based on ideology rather than function lose demand as interest fades, leading to sharp declines in value. Entrepreneurs who focus on sustainable growth and long-term profitability avoid investments that rely on fleeting enthusiasm rather than concrete financial principles. The fundamental truth of investing is that assets must provide lasting value to retain demand. A cryptocurrency that serves a unique function and improves financial infrastructure will continue to attract investors, developers, and users over time. An asset that is built on political branding rather than technological innovation will inevitably decline as attention shifts elsewhere. Entrepreneurs who understand this principle make investment decisions based on logic, real-world application, and proven financial models, ensuring they build wealth through assets that stand the test of time. Entrepreneurs who build sustainable wealth understand that trust is the foundation of any successful investment. Markets thrive on confidence, and financial assets that lack credibility inevitably collapse. Politically branded cryptocurrencies, such as Trump coin, face a fundamental problem. They lack trust from both the broader investment community and the general public. Without transparency, clear governance, and a solid technological foundation, these assets struggle to gain legitimacy, making them a risky and unreliable investment. Reputable cryptocurrencies and financial instruments are backed by strong development teams, transparent roadmaps, and clear utility. Bitcoin's trust comes from its decentralization, security, and predictable monetary policy, ensuring that no single entity can manipulate its supply. Ethereum's credibility is built on a vast developer ecosystem, smart contract functionality, and continuous innovation. These assets have proven their reliability over time, making them attractive to investors, institutions, and businesses. Politically branded coins, in contrast, lack these fundamental pillars, existing more as marketing tools than as true financial assets. One of the biggest threats to trust in any financial asset is lack of transparency. Serious investors require clear information about who controls an asset, how it is managed, and what its long-term goals are. Many politically branded cryptocurrencies fail this test, as they are often launched by anonymous or semi-anonymous creators who provide little insight into the project's governance. Without a clear development team, white paper, or roadmap, investors are left in the dark about how the coin will be developed, upgraded, or maintained over time. Another major issue is centralized control and potential manipulation. While legitimate cryptocurrencies operate on decentralized networks that distribute control among thousands of participants, politically themed coins are often highly centralized, with a small group of insiders holding significant portions of the supply. This creates a high risk of market manipulation, where early adopters or project founders control the price through coordinated buying and selling, leaving later investors exposed to massive losses when they decide to exit. Entrepreneurs who understand risk management avoid investments that lack security and accountability. Politically branded cryptocurrencies often suffer from poor security practices, weak code bases, and minimal development oversight, making them vulnerable to hacks, scams, and fraud. Without a strong technical foundation, these projects become easy targets for cyber criminals, and once trust is lost, the value of the asset declines rapidly. Regulatory scrutiny further erodes trust in politically themed assets. Governments and financial authorities closely monitor assets that appear speculative, misleading, or politically charged, increasing the risk of legal actions, exchange delistings, and financial penalties. Unlike established cryptocurrencies, which have been integrated into the broader financial ecosystem, politically branded tokens often face legal uncertainty that makes them unappealing to serious investors. Trust is not built on branding or political allegiance. It is built on proven technology, transparent governance, and real-world adoption. Assets that stand the test of time gain trust by demonstrating security, reliability, and consistent performance. Entrepreneurs who recognize the importance of credibility in investing understand that politically themed cryptocurrencies lack the transparency, decentralization, and institutional support necessary to be considered trustworthy assets. Without a foundation of trust, an asset's price is driven purely by hype and speculation, which are inherently unstable. The moment investors begin to question the legitimacy or security of an asset, its value declines rapidly, leading to massive losses for those who bought into the hype. Entrepreneurs who focus on long-term financial security avoid investments that lack transparency, are prone to manipulation, and fail to gain trust from the broader market. By prioritizing credibility, they ensure their investments are based on real value rather than marketing gimmicks and political branding. Entrepreneurs who build lasting financial success understand that broad market adoption is crucial for any asset to retain value over time. A cryptocurrency or investment that fails to achieve widespread acceptance beyond a niche audience is doomed to stagnation or collapse. Politically branded cryptocurrencies, such as Trump coins, struggle to gain traction outside of their targeted ideological group, limiting their potential for mass adoption. Without broad acceptance, an asset's liquidity, stability, and overall growth remains severely constrained, making it an unreliable and high-risk investment. Successful financial assets thrive because they offer universal appeal and real-world utility. Bitcoin, for example, is adopted across political and economic spectrums because it serves as a decentralized store of value that transcends borders, governments, and ideologies. Ethereum has gained massive institutional and retail adoption due to its smart contract capabilities, enabling decentralized applications in finance, gaming, and technology. These assets are not tied to a specific political figure or movement, allowing them to attract diverse users and investors worldwide. Politically themed cryptocurrencies, on the other hand, are inherently divisive, making them unattractive to a large portion of the market. A critical factor in any asset success is demand driven by practical use cases. Investors, businesses, and developers gravitate toward cryptocurrencies that offer tangible benefits, such as fast transactions, low fees, or improved security. Politically branded coins lack these essential features, as their primary appeal is symbolic rather than functional. A cryptocurrency that exists purely as a statement of political allegiance does not offer a compelling reason for adoption beyond those who already support the associated ideology. Without a meaningful use case, its demand remains limited to a small insular audience, rather than expanding to the broader financial and technological sectors. Liquidity is another major concern for assets that fail to gain widespread adoption. In well-established markets, high liquidity ensures that investors can buy and sell assets easily without significant price slippage. Cryptocurrencies with broad adoption, such as Bitcoin and Ethereum, benefit from deep liquidity pools that allow for smooth trading and price stability. In contrast, politically themed coins often experience low trading volumes, meaning that any large sale can cause a drastic drop in price. Investors who hold such assets may find it difficult to exit their positions without suffering major losses, further discouraging serious participation from the broader market. Another key issue is the lack of institutional support for politically branded cryptocurrencies. Institutional investors, including hedge funds, banks, and venture capital firms, seek assets with strong fundamentals, regulatory clarity, and long-term viability. Bitcoin and Ethereum have gained institutional acceptance due to their established infrastructure, security, and integration into the financial ecosystem. Politically themed coins, however, face significant resistance from institutions, as their ideological nature and speculative foundation make them unattractive for long-term investment. Without institutional backing, these assets remain confined to small-scale trading, unable to achieve the liquidity and stability necessary for sustained growth. Regulatory uncertainty further limits adoption. Governments and financial authorities closely monitor politically charged financial instruments, increasing the risk of legal restrictions, exchange delistings, and market limitations. Unlike mainstream cryptocurrencies that have made efforts to comply with regulations and integrate with financial systems, politically themed tokens often operate in a legal gray area, discouraging potential investors who seek security and compliance in their financial decisions. Entrepreneurs who understand financial markets recognize that adoption is the key driver of an asset's long-term success. Assets that fail to appeal to a broad and diverse user base are inherently fragile, as they depend on a limited pool of investors who may eventually lose interest. Politically branded cryptocurrencies are particularly susceptible to declining demand as they rely on short-term enthusiasm rather than sustained organic growth. Without widespread market adoption, an asset remains speculative and unable to generate the long-term value necessary for serious investment. Entrepreneurs who build lasting wealth understand that regulatory risks can make or break an investment. Governments and financial authorities play a crucial role in shaping the long-term viability of assets, and politically branded cryptocurrencies like Trump coin exist in a legal gray area that increases uncertainty and potential consequences for investors. Unlike well-established cryptocurrencies that have worked toward regulatory compliance and institutional acceptance, politically themed coins face heightened scrutiny, making them a high-risk and unstable investment choice. Regulators worldwide are cracking down on cryptocurrencies that appear speculative, misleading, or prone to manipulation. The rise of politically branded tokens often attracts attention from financial watchdogs, who view them as potential schemes rather than legitimate digital assets. Many of these tokens lack clear legal frameworks, transparent governance, and compliance measures, making them easy targets for regulatory intervention. Governments are increasingly focused on protecting consumers from fraudulent or high-risk investments, and politically branded cryptocurrencies frequently fall into categories that raise red flags among regulators. A major risk with politically themed cryptocurrencies is the possibility of government enforcement actions, including fines, restrictions, and outright bans. Cryptocurrencies like Bitcoin and Ethereum have gained regulatory clarity in many regions, enabling their integration into the financial system and attracting institutional investors. In contrast, politically branded coins often exist on the fringes of legality, making them susceptible to sudden regulatory crackdowns. Exchanges that list high-risk assets may be forced to delist them under legal pressure, reducing liquidity and leaving investors trapped in an illiquid market with limited options for exiting their positions. Another significant challenge is the potential classification of politically themed cryptocurrencies as unregistered securities. Regulators like the U.S. Securities and Exchange Commission, SEC, have taken action against numerous crypto projects that fail the Howey test, which determines whether an asset qualifies as a security. Many politically branded tokens operate without clear use cases, decentralized governance, or technological innovation, making them likely candidates for scrutiny. If a regulatory body classifies such a token as an unregistered security, investors may face legal risks, fines, or forced liquidation. Entrepreneurs who make sound financial decisions understand that compliance is key to long-term success. Assets that operate in a legally uncertain environment struggle to gain trust from institutions, businesses, and mainstream investors. Politically branded cryptocurrencies, which are often launched with minimal regulatory oversight, face significant barriers to adoption as a result. Without strong compliance measures and legal clarity, these assets remain speculative and vulnerable to market shocks triggered by regulatory action. Another regulatory risk is the increased likelihood of anti-money laundering, AML, and know your customer, KYC scrutiny. Global regulators, including the Financial Action Task Force, FATF, have introduced strict rules for cryptocurrencies to prevent their misuse for illicit activities. Exchanges and financial institutions must comply with strict KYC and AML procedures, and assets that raise concerns about their legitimacy or use cases are often restricted or removed from major trading platforms. Politically branded cryptocurrencies, which sometimes lack transparent ownership structures and compliance measures, are at high risk of being targeted by regulators looking to enforce AML policies. Governments may also introduce broad regulations that limit the use of politically charged financial assets to prevent potential market manipulation, fraud, or destabilization. If a politically branded cryptocurrency becomes associated with questionable financial practices, election interference, or ideological fundraising, authorities may impose severe restrictions on its use, trading, or circulation. Unlike well-established cryptocurrencies that have worked to integrate within legal and financial frameworks, politically themed tokens often operate outside of mainstream financial systems, increasing their exposure to legal uncertainties and sudden market restrictions. Entrepreneurs who focus on long-term stable investments recognize that regulatory uncertainty poses a significant threat to politically branded cryptocurrencies. Assets that operate in legally unregulated or high-risk environments tend to face sudden disruptions, exchange delistings, and financial losses due to enforcement actions. Without strong legal standing and institutional backing, these tokens remain fragile, speculative, and vulnerable to future regulatory challenges that can severely impact their value. Entrepreneurs who build sustainable financial success understand that market manipulation poses a serious risk when investing in speculative assets. Well-established investments thrive on transparency, liquidity, and organic demand. But politically branded cryptocurrencies like Trump coin often lack these essential market protections, making them vulnerable to price manipulation, pump and dump schemes, and insider trading. Unlike Bitcoin and Ethereum, which operate on large, decentralized networks with deep liquidity, politically themed tokens often rely on small, concentrated groups of investors who can artificially control price movements, creating a dangerous environment for serious investors. Market manipulation occurs when a small group of insiders controls a significant portion of an asset's supply, enabling them to artificially inflate the price and create the illusion of demand. Many politically branded cryptocurrencies suffer from centralized ownership, meaning that a handful of individuals hold the majority of available tokens. When early adopters or project founders decide to sell their holdings, it can cause a rapid price collapse, leaving retail investors with substantial losses. Without distributed ownership and organic adoption, these assets remain highly susceptible to orchestrated price movements that distort their true value. A common tactic in manipulated markets is the pump and dump strategy, where early investors or project insiders artificially drive up the price through coordinated marketing campaigns, social media hype, and misleading claims about the asset's potential. Once the price reaches an artificially inflated level, prices cause the price to plummet and leaving unsuspecting investors with worthless tokens. Politically themed cryptocurrencies are particularly vulnerable to this, because their value is often based on sentiment rather than fundamentals, making it easier for manipulators to exploit temporary enthusiasm and then exit with significant profits. Another major concern is wash trading, where a small number of investors or bots artificially inflate trading volume to make an asset appear more active and desirable than it actually is. This deceptive practice creates the illusion of demand, encouraging new investors to buy in under the assumption that the asset has real market traction. However, once wash trading stops, the lack of genuine demand becomes clear, leading to a steep decline in price and liquidity. Legitimate cryptocurrencies with broad adoption attract organic trading volume from global investors, whereas politically branded tokens often rely on artificial volume to sustain short-term interest. Low liquidity is another red flag for market manipulation. Well-established cryptocurrencies benefit from deep liquidity pools, allowing investors to buy and sell without drastically impacting price stability. Politically branded tokens, however, often suffer from low liquidity, meaning that any significant buy or sell order can cause extreme price swings. Low liquidity makes it easier for manipulators to control price movements, as a relatively small amount of capital can create dramatic spikes or crashes, further increasing risk for unsuspecting investors. Lack of regulatory oversight in politically branded cryptocurrencies increases the potential for unethical trading practices. While mainstream digital assets are moving toward greater transparency and institutional legitimacy, politically themed tokens often operate without clear guidelines, making them attractive targets for bad actors. Without audits, compliance measures, or security protocols, these assets remain highly speculative and prone to unethical behavior that can harm investors. Entrepreneurs who prioritize financial security and long-term stability recognize the dangers of investing in assets that lack market integrity. When an investment is driven by manipulation rather than genuine demand, it becomes a high-risk gamble rather than a sound financial decision. Serious investors avoid markets that can be easily controlled by a small group of individuals, ensuring that their capital is allocated to legitimate assets with strong fundamentals, real-world adoption, and market transparency. Entrepreneurs who focus on long-term financial success understand that brand longevity is essential for any investment to maintain value over time. Successful cryptocurrencies and financial assets are built on technological innovation, widespread adoption, and real-world utility, ensuring their relevance for years to come. Politically branded cryptocurrencies like Trump coin, however, rely heavily on short-term political cycles and public sentiment, making them vulnerable to rapid declines in relevance and value. Unlike Bitcoin, Ethereum, and other major cryptocurrencies that have demonstrated long-term staying power, politically themed tokens are tied to transient political figures and movements, making them an inherently unstable and high-risk investment. Financial assets that stand the test of time transcend political and social trends. Bitcoin's appeal is its decentralized nature, fixed supply, and ability to act as a store of value regardless of government policies or leadership changes. Ethereum's long-term success is driven by its smart contract capabilities and extensive developer ecosystem, making it a foundational technology for decentralized applications. These assets do not depend on any single individual or political ideology, ensuring that their value remains independent of temporary market trends. Politically branded cryptocurrencies, however, are deeply linked to the reputation, influence, and political standing of a single person or movement, making them highly susceptible to declining interest once political circumstances change. Public perception shifts over time, and assets that rely on a specific political brand face significant risks when that brand loses popularity or fades from public discourse. The value of a politically themed cryptocurrency is often tied directly to the reputation of the individual or ideology it represents. If a political figure becomes less influential, controversial, or loses support, interest in the associated cryptocurrency can decline sharply, leading to a collapse in demand and liquidity. In contrast, mainstream cryptocurrencies have proven their ability to weather market cycles and maintain relevance due to their underlying technology and adoption across industries. One of the biggest challenges for politically branded cryptocurrencies is sustaining investor confidence beyond election cycles and political events. Elections, political campaigns, and movements have limited lifespans, meaning that assets tied to them must constantly reignite interest to avoid becoming obsolete. Once the political momentum fades, the asset's demand plummets, leading to severe price volatility and long-term devaluation. Investors who understand market cycles avoid assets that lack intrinsic utility and long-term staying power, recognizing that politically driven hype rarely translates into sustainable financial growth. Long-term investors prioritize assets that can adapt and evolve with changing market conditions. Bitcoin's continued relevance is due to its growing acceptance as a global store of value, while Ethereum remains attractive due to ongoing upgrades and developer innovation. Politically themed cryptocurrencies, however, lack the technological foundation to evolve, making them highly susceptible to becoming outdated. Without continuous development, institutional adoption, and strong security measures, these assets face an inevitable decline once the initial excitement fades. Institutional investors, hedge funds, and large-scale market participants avoid assets that are built on short-term trends. Bitcoin and Ethereum have attracted institutional investment due to their proven track record, regulatory progress, and market resilience. Politically branded cryptocurrencies, however, often fail to gain institutional backing because they lack the credibility, longevity, and infrastructure necessary for large-scale adoption. Without institutional support, these assets remain highly speculative and limited to niche investors, further reducing their long-term viability. Entrepreneurs who make strategic investment decisions understand that long-term success requires durability, adaptability, and broad market adoption. Cryptocurrencies that survive and thrive over decades are those that offer real-world applications, technological advancement, and widespread trust among users. Politically branded cryptocurrencies, however, face a rapid decline in relevance once public interest shifts, making them an unsustainable investment. Without a solid foundation beyond political branding, these assets fail to generate lasting value, leaving investors exposed to significant long-term financial risks. Entrepreneurs who focus on sustainable wealth creation understand that trust and credibility are the foundation of any successful investment, Financial markets, businesses, and institutional investors gravitate toward assets that demonstrate transparency, accountability, and long-term viability. Politically branded cryptocurrencies like Trump coins struggle to establish credibility beyond a specific ideological audience, making them inherently risky and unattractive to serious investors. Without trust from a broad user base, financial institutions, and regulatory bodies, these assets remain speculative and prone to collapse once initial hype fades. Established cryptocurrencies like Bitcoin and Ethereum have earned credibility through years of development, security, and real-world adoption. Bitcoin's decentralized nature, capped supply, and ability to act as a store of value resistant to inflation have made it widely trusted among institutional and retail investors alike. Ethereum has built a vast ecosystem of decentralized applications, smart contracts, and financial services, reinforcing its status as a legitimate and indispensable financial technology. These assets did not rely on political branding, marketing gimmicks, or ideological movements to gain trust. They built it through technological innovation and market resilience. Politically themed cryptocurrencies, however, rely on sentiment rather than substance, making their trustworthiness highly unstable and vulnerable to changing political landscapes. Trust in any financial asset is built through transparency and strong governance. Bitcoin operates on a completely decentralized and open source model, allowing anyone to verify transactions, network security, and development progress. Ethereum has clear development roadmaps, transparent updates, and a dedicated global community driving innovation. Politically branded cryptocurrencies, in contrast, often suffer from opaque ownership structures, questionable tokenomics, and centralized control, raising serious concerns about legitimacy, insider manipulation, and potential fraud. Investors who understand financial security avoid assets that lack transparency and verifiable governance, as these assets carry high risks of mismanagement, scams, or sudden collapses. A significant factor in trust and credibility is security and resilience against external threats. Bitcoin has survived over a decade of cyber attacks, regulatory scrutiny, and market volatility, proving its strength as a decentralized and censorship-resistant financial asset. Ethereum has undergone major upgrades and security improvements, ensuring its continued reliability in a rapidly evolving digital economy. Politically branded cryptocurrencies, however, often lack robust security measures, rigorous auditing, and long-term development plans, making them highly susceptible to hacks, regulatory shutdowns, and investor losses. An investment without strong security protocols and infrastructure is inherently unreliable, discouraging serious financial participants from engaging with it. Reputation plays a crucial role in the success of any investment. Financial markets are built on trust in institutions, regulatory compliance, and ethical business practices. Politically themed cryptocurrencies often face public skepticism, media scrutiny, and association with speculative or controversial figures, making them a reputational risk for investors. Unlike established assets that have built credibility over years through real-world use cases and financial integration, politically branded tokens often struggle to gain mainstream acceptance due to their polarizing nature and limited market appeal. The lack of credibility in politically branded cryptocurrencies extends to the reluctance of major exchanges to support them. Leading cryptocurrency exchanges prioritize assets with strong market demand, compliance, and security standards. Politically themed tokens often face listing difficulties, frequent delistings, and liquidity problems, making them even less attractive for serious investors. Without widespread exchange support and regulatory approval, these assets remain highly speculative and difficult to trade, further reducing their credibility in the broader financial ecosystem. Entrepreneurs and investors who seek financial stability, long-term growth, and risk management understand that trust and credibility are non-negotiable in any investment. Assets that lack transparency, strong governance, real-world utility, and institutional support fail to earn the confidence of serious investors and financial institutions. Politically branded cryptocurrencies struggle to establish legitimacy beyond short-term speculation, making them an unreliable and high-risk financial choice. Without a foundation of trust, credibility, and sustainable market demand, These assets remain unsuitable for entrepreneurs who prioritize long-term financial success and stability.